$5,000, 3 index funds. This is my actual 2026 allocation, not a hypothetical, not what I do, what I'm doing. 60% US stocks, 30% international, 10% bonds. And in the next 21 minutes, I'm going to break down exactly why I chose these 3 funds, why these specific percentages, and why $5,000 is the perfect amount to move beyond the single fund strategy. If you watched my $1,000 investment video, this is the next level. More diversification, same simplicity, let's go. If you want investing strategies that scale with your wealth but stay simple, subscribe right now. No complicated portfolios with 50 funds, no guru BS, just real allocations for real amounts of money. Hit subscribe, let's build this. First question, if I told you to put $1,000 into VTI and call it a day, why am I now telling you to split $5,000 across 3 funds? What changed? The answer is math. At $1,000, diversification costs more than it helps. Here's why. If you split $1,000 3 ways, you're putting $333 into each fund. Some brokerages charge fees. Some funds have minimums. And the benefit of diversification at that small amount is tiny compared to the friction of managing 3 positions. But at $5,000, the math flips. You can put meaningful amounts into each fund, $3,000 into US stocks, $1,500 into international, $500 into bonds. Now, diversification actually reduces your risk without adding much complexity. And here's what diversification actually does. It reduces volatility. US stocks crash 20%. International might crash 15%. Bonds might go up 5%. Your blended portfolio crashes maybe 12% instead of 20%. That's the benefit. Less extreme swings, smoother ride, same long-term returns. Is it necessary? No. Plenty of people put everything in VTI and do great. But at $5,000, adding international and a tiny bond allocation costs you nothing in returns and gives you meaningful risk reduction. That's why I'm doing it. Fund number 1, VTI, Vanguard Total Stock Market ETF. This gets 60% of my $5,000, $3,000. And this is the foundation of the entire portfolio. VTI owns every publicly traded company in America. 3,500 companies. Apple, Microsoft, Amazon, Tesla, but also mid-sized companies, small companies, everything. When you buy VTI, you own the entire US economy. Why 60%? Because the US stock market has been the highest returning asset class over the last century. Average 10 to 11% annually. Some years up 30, some years down 20. But over time, it compounds like nothing else. And the US market represents about 60% of global stock market value. So 60% of my portfolio matches the global allocation. Expense ratio, 0.03%. For every $1,000 you pay 30 cents per year, basically free. And at Fidelity or Schwab, you can buy fractional shares, so your full $3,000 gets invested with no cash sitting idle. If you're using Fidelity, the equivalent is FZROX. Fidelity Zero Total Market Index. Same thing. Entire US market. But expense ratio is literally 0. Free. Only at Fidelity though. Can't transfer it to other brokerages. If that doesn't bother you, FZROX works great. Quick reminder. Why not just buy Apple and Microsoft? Because you don't know which companies will win. VTI owns them all. The winners pay for the losers. And you don't have to guess. Fund number 2. VXUS, Vanguard Total International Stock ETF. This gets 30%, $1,500, and this is the fund most people skip. Big mistake. Here's what you're missing if you only own US stocks. The US is about 60% of global stock market value. The other 40% is international, Europe, Asia, Latin America, emerging markets. If you only own VTI, you're ignoring half the world's companies. VXUS owns about 8,000 companies across 47 countries. Japan, UK, China, Germany, France, Switzerland. Companies like Nestle, Samsung, Toyota, ASML. These are massive global companies. And they're not in VTI. Why own international? 3 reasons. 1. Diversification. When US stocks struggle, international sometimes does better. Not always, but sometimes. 2. Currency hedging. You're not just betting on the dollar. 3. You get exposure to growth in other economies. Now here's the truth. Over the last 15 years, US stocks crushed international. VTI way outperformed VXUS. But over the last 50 years, they trade places. Some decades US wins, some decades international wins. You don't know which will win the next decade, so you own both. Why 30% and not 50? Because I'm slightly overweighting US. The market cap says 40% international. I'm doing 30. Why? Because the US has deeper markets, better regulations, and historically higher returns. 30% gives me international exposure without betting against the US expense ratio. 0.07%. $7 per year on 10,000 invested, still basically free. Fidelity equivalent is FZILX. Fidelity Zero International Index. Same thing, 0 expense ratio, only at Fidelity. Fund number 3, BND, Vanguard Total Bond Market ETF. This gets 10%, $500. And this is the most debated part of the portfolio. What are bonds? They're loans. You're lending money to the US government or corporations. They pay you interest, usually 3 to 5%. In exchange, bonds are stable. When stocks crash 20%, bonds might go up 2% or stay flat. They're the shock absorber in your portfolio. Here's the traditional advice. Your bond allocation should equal your age. 25 years old, 25% bonds. 40 years old, 40% bonds. I'm ignoring that. Why? Because I'm young enough to handle stock volatility and I want growth, not stability. So why have any bonds at all? 2 reasons. 1. It smooths returns. During the 2020 crash, a portfolio with 10% bonds dropped less than 1 with 0 bonds. Not by much, but some. 2. It gives me dry powder. When stocks crash, I can rebalance by selling bonds and buying stocks at a discount. You'll see how that works in a minute. If you're over 40 or you can't stomach big drops, go higher on bonds. 20 or 30%. If you're under 30 and aggressive, you could skip bonds entirely and go 80 VTI, 20 VXUS. I'm doing 10% bonds as a middle ground. Small safety net, still aggressive. Expense ratio, 0.03%, $3 per year on 10,000. Fidelity equivalent is FXNAX. Fidelity US Bond Index Fund. Schwab has SWAGX. All basically identical. Okay, so VTI 60%, VXUS 30%, BND 10%. Why these exact numbers? This is called an aggressive growth allocation. 90% stocks, 10% bonds. It's designed for long time horizons, 10 to 30 years. If you're young and working, this allocation maximizes growth while giving you a tiny stability cushion. Could you do different percentages? Absolutely. 70 VTI, 20 VXUS, 10 BND, that's more US heavy, fine. 50 VTI, 30 VXUS, 20 BND, more international and more conservative. Also fine. 80 VTI, 20 VXUS, 0 BND, super aggressive, works too. The truth is the exact percentages matter less than you think. A 60-30-10 portfolio and a 70-20-10 portfolio will perform almost identically over 20 years. The big decision is stocks versus bonds, 90-10 versus 70-30. That matters. Whether you do 60-30 or 70-20 in stocks, barely matters. So why 60-30-10 for me? Because it matches roughly global market cap with a slight US tilt. And 10% bonds is enough to reduce volatility a bit without sacrificing much growth. It's not the only right answer, it's just my answer. Now let's talk about rebalancing, because once you have 3 funds, they're going to drift from your target allocation, and you need a plan to fix that. Here's what happens. You start with 60 VTI, 30 VXUS, 10 BND. 1 year later, US stocks went up 20%. International went up 5%. Bonds stayed flat. Now your allocation is 65 VTI, 27 VXUS, 8 BND. It drifted. Rebalancing means selling some of the winners and buying more of the losers to get back to 60-30-10. Sounds backwards, but it's actually brilliant. You're selling high and buying low automatically. No emotion, just math. How often? Once per year. Pick a date. I do it every January 1st. You look at your allocation. If anything is off by more than 5 percentage points, you rebalance. If VTI is at 65 and your target is 60, sell 5% of VTI and buy VXUS or BND to get back to target. Two important notes. 1. If this is in a Roth IRA, rebalancing is tax-free. Sell and buy all you want, zero tax. If it's in a taxable account, selling creates capital gains tax. In that case, rebalance by directing new contributions to the underweight funds instead of selling. 2. If your portfolio is small, don't stress about perfect rebalancing. Close is fine. Let's talk about the mistakes that kill 3-fund portfolio investors. Mistake 1. Adding more funds. You have VTI, VXUS, BND. Then you hear about a tech fund. Add that. Then a small cap value fund. Add that. Then sector rotation. Before you know it, you have 20 funds. You just recreated VTI with extra steps and higher fees. Stick with 3. Resist the urge to tinker. Mistake 2. Changing your allocation based on recent performance. U.S. stocks crushed it last year. Increase U.S. to 80%. International sucked. Drop it to 10. Now you're just chasing performance? And you'll always be 1 year late. Set your allocation. Stick with it. Rebalance to it annually. Don't chase. Mistake 3. Skipping international because U.S. is winning right now. The last 10 years, U.S. dominated. So everyone thinks international is pointless. But the decade before that, international won. And the decade before that, U.S. won. They take turns. If you only own U.S. during an international winning decade, you'll regret it. Mistake 4. Putting too much in bonds too early. You're 25. You have 40 years until retirement. Putting 50% in bonds because you're scared of volatility? You just gave up decades of growth. 10 to 20% bonds max until you're 40. Mistake 5. Never rebalancing. You set 60-30-10. 10 years later, it's 80-15-5 because U.S. grew so much. Now you're way overexposed to U.S. And when U.S. finally corrects, you'll lose more than you should have. Rebalance once a year. Takes 10 minutes. Finally, let's answer the big question. When should you use 1 fund versus 3 funds versus more? Under $3,000. 1 fund. VTI or FZROX. Don't split it. Diversification doesn't help enough at that size to justify the complexity. Just buy the whole U.S. market and keep it simple. $3,000 to $50,000. 3 funds. VTI, VXUS, BND, or equivalents. Now, diversification makes sense. You've got enough money to allocate meaningfully, and 3 funds is still simple enough to manage. Over $50,000. You can stick with 3 funds forever, or you can get fancy with tax loss harvesting, Roth conversions, and more advanced strategies. But honestly, 3 funds still works perfectly. Some people with millions just hold VTI, VXUS, BND. Simplicity scales. The real answer is personal preference. If you want maximum simplicity and you're okay with slightly higher volatility, 1 fund works forever. If you want smoother returns and global diversification, 3 funds works forever. There's no objectively right answer, just trade-offs. What am I doing? At $5,000, I'm using 3 funds because I want international exposure and a small bond cushion. If I only had $1,000, I'd use 1 fund. If I had $50,000, I'd still use 3 funds. The strategy scales, and that's the beauty of it. $5,000. 3 funds. VTI 60%, VXUS 30%, BND 10%. This is my actual 2026 allocation. Not theory, not a course. Just what I'm doing with real money. If this video gave you a clear 3-fund plan, hit that like button. If you want more portfolio strategies that scale with your wealth, subscribe. Because I'm building my portfolio in public and showing you every allocation, every fund, every decision. No BS, just what actually works. $5,000, 3 funds. Build it, rebalance it once a year, and let it run. I'll see you in the next one.